What's up guys, and welcome back to Wall Street Millennial. On this channel, we cover everything related to stocks and investing. In this video, we're going to talk about a massive fraud that has been going on in the public real estate industry. Specifically, it involves the manager of several publicly traded REITs. In the fraud, the perpetrator funneled tens of millions of dollars of investor money into his own personal accounts and into the accounts of one of his other companies. It took place over the course of 10 years and was only recently uncovered by the SEC. The perpetrator used a combination of self-dealing, tricking his board members, and flat-out transferring money out of his REITs into his own bank account to defraud investors of more than $30 million. We're going to go over all the details, from what position he was in to enable the fraud, to the specifics of what the fraud actually was. Michael Shustak is a 62-year-old Las Vegas resident who ran two publicly traded real estate investment trusts, or REITs. You may even have been an investor in one or both of these REITs yourself. Back in 2006, he got in trouble with the SEC for violating securities laws through two of his earlier companies. In that instance, Shustak raised hundreds of millions of dollars for previous real estate funds. In hundreds of seminars and presentations, he misrepresented the payout ratios of the funds. He claimed that the historical payout ratios he advertised were a percentage of net income as opposed to funds from operations. With the type of fund that these were, it is generally understood that net incomes are significantly lower than funds from operations. Because of this, payout ratios based on funds from operations are generally much higher than those based on net income. By making these claims, he deceived investors into thinking the funds performed much better than they actually did, and was able to raise hundreds of millions of dollars as a result. After the violation, Shustak was fined $100,000 and barred from representing any broker. But despite that, he continued running his own publicly traded companies, including two REITs with ticker symbols VRTA and VRTB. In the mid-2010s, both of the REITs fell into penny stock status and were delisted from the Nasdaq. Currently, they only trade on over-the-counter markets. Although his two REITs had significant assets owned by public shareholders, Shustak had near total control over them. He used his power to drain the REITs of their assets, to his own personal benefit and to the benefit of another company that he had significant interests in. Shustak had another company besides VRTA and VRTB, called the Parking REIT, which he had a significant personal stake in. This REIT engages primarily in parking lots and parking garages. Shustak made this REIT his main business, likely because he thought it had more potential than his first two REITs. In an effort to give the Parking REIT a boost, he decided to use his near total control over the two other REITs to funnel their assets into the Parking REIT. He was able to blatantly have the other two REITs pay the bills of the Parking REIT. These bills were for things like business asset purchases, taxes, utilities, and administrative costs. Shustak used the two REITs to pay the Parking REIT's bills with surprising blatancy. Whenever money was transferred to the Parking REIT, Shustak never wrote up any written contracts or receipts for their multi-million-dollar payments. Instead, the money was just transferred out of the corporate accounts. This was only possible because Shustak had complete control over the day-to-day operations of the REITs. In public financial reports, he marked the deficit in cash reserves as loans to be repaid by the Parking REIT. However, these loans were of course never paid back, or ever had the intention of being paid back. It was simply a way for Shustak to buy some more time before people figured out what was going on. In the end, a staggering $29 million was siphoned off from the REITs into Shustak's Parking REIT. This contributed to the Parking REIT, which is not publicly traded, gaining the interest of institutional investors at high valuations. But Shustak's fraud didn't end there. He also operated his two REITs in a way that funneled assets to the Parking REIT and to himself personally. Over a period of 4 years, he had the REITs buy and sell several Las Vegas office buildings multiple times. Each time, the counterparty to the transactions were either the Parking REIT itself or one of Shustak's friends' companies. These transactions were consistently unfavorable to the REITs. They would sell the buildings at a low price and buy them back at much higher prices multiple times. The result of the fraudulent self-dealings resulted in the Parking REIT gaining millions of dollars, Shustak's friend getting millions of dollars, and Shustak himself taking home $1.75 million of illegal profits. At one point, a single transaction cost one of the REITs $10 million. In the 2000s, one of Shustak's friends' companies built an office building with a construction loan from the REIT. However, 6 years later, Shustak decided to have the Parking REIT buy that same property from his friend. In order to make the deal look more favorable for the Parking REIT and to attract more big-time investors, he forgave the remaining $10 million owed on the construction loan to the REIT. The REIT got nothing in return for forgiving the loan. Just a year later, the Parking REIT sold the building back to VRTA and VRTB for more than $50 million, and another 2 years after that, they were bought back again from the REITs. This churn resulted in a loss of $9 million for the REITs. The churn continued for a few more wheelings and dealings in the later 2010s. All the while, Shostak racked up $1.5 million worth of commissions on the transactions, paid to none other than Shostak himself. It may seem strange that the CEO of a public company can pay himself for real estate transactions. In reality, it was likely illegal, but Shostak was able to trick his board members into approving the transaction commissions. He lied to the board members by telling them that he was technically entitled to the standard 3% commissions on the real estate transactions. In reality, under the specifics of the contracts, he was not entitled to any commission. The CFO of VRTA and VRTB knew that this was the case and protested, but Shostak went on paying himself anyway. When Shostak was able to successfully trick the board members into approving the commissions, the CFO resigned. Over the course of several such commission payments, Shostak became so confident in his fraud that he started paying himself the commissions before gaining the approval from the board members. By 2017, Shostak's ravaging of VRTA and VRTB had sucked the companies almost dry of all of their assets. Their stock prices collapsed, and the total market value of both companies combined shrunk to only $7 million. By this point, both companies had been delisted by the Nasdaq and were only traded over the counter. But in Shostak's eyes, this just proved a further opportunity to extract the last bit of value from the companies under the reduced financial scrutiny of being OTC. Shostak owned yet another company called Vestin Advisor that provided investment advising services. He hired an expert consultant to calculate a fair value for this company, telling the consultant that the company was making $1.5 million per year. He also told the same consultant that the company's profits would likely increase 5% per year in the near future. Based on this information, the consultant gave the company a valuation of $32 million. Shostak then took this valuation and approached the board of VRTA and VRTB. He proposed that VRTA and VRTB purchase Vestin for $8.7 million. Based on the $32 million valuation from the expert consultant, this appeared like an extremely accretive deal, valuing the company at nearly 4 times what they were paying for it. But in reality, the assumptions that Shostak told the expert consultant to make were pure fabrications. Vestin did not make $1.5 million a year. In fact, it only made about 1/10 of that amount. Furthermore, it was losing clients and likely to see profits reduce in future years, rather than grow by 5% per year as Shostak said. But neither the boards nor the valuator knew this information, and the boards agreed to pay $8.7 million to acquire Vestin. This accounted for more than the total market cap of both REITs combined. In this way, Shostak was able to extract the last $8.7 million that he could out of the dying REITs. He was the sole owner of Vestin before the purchase, so he received the full $8.7 million personally from the transaction. Shostak apparently thought that no one would expose him and readily lied to investors on the annual and quarterly reports for VRTA and VRTB. But somehow, the SEC was able to uncover his fraud once again and is asking a judge to force him to disgorge all of his ill-gotten gains. Even if he does, he probably has spent the majority of these gains since he got them. It's unlikely that any of the early investors in VRTA and VRTB will ever get any of their money back. The best they can hope for is that Shostak may be brought to justice with jail time, or a fine for the remaining money that he hasn't yet spent. Alright guys, that wraps it up for this video. If you enjoyed this content, make sure to smash the like button, and subscribe so you don't miss future uploads. In the meantime, thank you so much for watching, and we'll see you in the next video. Wall Street Millennial, signing out.